the Fed and the quantitative easing, Yellen did cause a little bit of a hoo-ha when she said, okay, once the quantitative easing is over, we start even hiking rates. I think today is a job report that comes out. I don't want to go into too much detail. Just tell me that. How much confidence is there in continued quantitative easing and easy money in the U.S. and hence also in growth momentum?
Well, Janet Yellen is a very smart, experienced economist. She lived through the financial crisis. She was at the table side by side with Ben Bernanke. So her instincts are good instincts. It is a different position when you're speaking publicly for the Fed. So that was her first news conference. And what tends to happen is sometimes you say things that history, in terms of what happens in the future as you're looking backwards at history, may result in different outcomes. What she was saying is pretty sensible, that we'll be slowly exiting from QE. Some people debated whether you should have done the third QE. And the fact that we're exiting is to be expected. And it's like taking a patient off of life support when it's actually breathing fine. And whether interest rates go up a tiny bit or not really won't affect the U.S. economy very much. I think there's a real overreaction on the point of economists and the fact that we now have a 24-hour news cycle. We have financial reporters every place, and they must report on something. So the fixation on what the Fed's doing is perhaps warranted, but it's a bit overdone. And whether interest rates move up 50 basis points or interest rates move up 100 basis points over a year or over a year and a half is not going to be determinative of major changes in the economy. Particularly in the U.S., we have consumers that are really at low levels of leverage. We have companies with about $2.5 trillion of cash and very little debt. We have great oil and gas resources. We're going to be energy self-sufficient for the first time in history. Our tech business there is really enormously strong and a global leader. And so we have a lot of good things. Auto production is close to record levels, and a lot of it's stimulated by the Fed, but some of it isn't. And housing is doing very well. And what we've learned, counter to some economists I just listened to in a presentation, is if interest rates go up modestly in the housing business, 25 of the last 26 years, when interest rates went up, housing prices went up. Just the opposite of what you'd expect. Depends how fast interest rates are going up. It may slow down the volume of houses, but if interest rates go up, because the economy is strong, housing almost invariably continues to go up. So I think the Fed is careful. They basically saved the global economy, and they don't want to throw it back into recession. So I have more confidence, perhaps, than some others, that they'll manage to find the right balance between reversing the QE, letting interest rates go up a little bit at some period of time, which is probably an overall good thing.
Steve, thank you so much for your time and your insights.